Hello and welcome to Switzer TV Investing. I'm Peter Switzer, and what a day. The stock market down a real lot. And we'll be talking to Julia Lee from Birmingham Invest and Michael McCarthy from CMC Markets to see how worried they are. Is this a buying opportunity? And then we'll catch up with Paul Ricard and Charlie Aitken to see if they're worried, if there's a buying opportunity. And finally, St Wong from Prime Value will give us his insights into what he thinks is going on and how he's actually going to play it. This is a very, very difficult day, but the question is this the turning point or will it get worse? That's the show. So without any further ado, let's go to Michael McCarthy and Julia Lee. So guys, I didn't expect a 7.3% fall in the ASX 200. Did either of you expect that kind of thing?
No, I mean, those oil price moves that we saw over the weekend and this morning have been horrific. And just putting it into context, I mean, it is a historic fall. We don't see this very often. In fact, this is the second largest fall that we've seen in the benchmark ASX 200 since it started in 1992. And the only fall that's been higher than that or bigger than that has been after Lehman Brothers in 2008. So October 2008 was the biggest one-day fall that we saw.
How big was that?
That was, I don't know.
Was more than 7.3%?
Yes.
Yes, okay.
It was about don't quite me on it, I think it's about 8.1%.
Well, you quoted yourself because you're on live TV, they've seen you do it. All right, Michael, look, I've got to say, a couple of smart guys I know actually called me on Saturday after Wall Street's closed, and I said, we could be getting close to the end, but of course the oil price story hadn't come out. What were you feeling on Friday?
Worried, Peter, because I do read fundamentals, I listen to economists, I look at the charts, I do all those things. But for me, the thing that really determines what the market's going to do is its own action. The price action tells the story. And as we said last week, Peter, when we see dramatic falls like this on double the average daily volume, it's a sign that there's further damage to come. Those straight drops, closing at the lows. So I didn't predict a 7.3% fall today, Peter, but I was expecting further falls because the price action's indicating that.
Well, I hadn't. A couple of my colleagues who are usually more negative than me, like Paul Ricard, he was far more positive than I was, which I thought was a bad indicator when he's more optimistic than me. But I must admit, I didn't expect this, but I didn't realise that an oil price problem was going to come. But do you think that computer trading and ETFs are actually making the volatility much bigger swings? Because basically, like in our case, if you're in ETFs, you're dumping the two areas, banks and resources, that are under threat from the stories going on now.
Look, I think we are seeing capitulation in terms of the market, and whenever you see capitulation, you do see things coming into the picture. You do see momentum traders selling, you see margining happening as well. But look, when you think back to the global financial crisis, I think there was a lot more margining happening then. I think traders now, most have lived through the global financial crisis, so they understand what happens in times of volatility. And look, I've gone back in time and had a look at volatility, and it does tend to cluster. When you have a look at those days where we've seen falls of more than 6%, 4 of those were in 2008 during the global financial crisis. So usually when you see magnitudes, falls of this magnitude, they do tend to cluster around certain events. So for anyone who's looking at the market as a bargain, my general rule of thumb, as I said last week, is to wait 2 months because the volatility does tend to take 2 to 3 months.
But when does the 2 months start? From the day or from when it started, say, a couple of weeks
ago? Yeah. So I'd be looking for opportunities. This is just me, from around about May. And really, we're still waiting to see how the coronavirus develops because that's at the core of the market's concern at the moment. But generally,
so
that's
you're not shopping for stocks yet, or are you watching? If something's ridiculous, you would buy it?
I don't catch falling knives, Pete. If you know me by now,
But why not? What's wrong with catching falling knives? Are you a fraidy cat or something?
I can't sleep at night. I think in this type of environment, capital preservation is key. And look, we talk about the financial impacts, but there's going to be a lot of real world impacts here as well. So you've got to feel for retirees who are going to find it hard to find a yield in terms of term deposit, any contractors out there. There's going to be a fair bit of pain there.
Macca, if Donald Trump rings up the Sheikh and says, hey, cut this out. This is really going to ruin the world and my election chances. Would the sheik do as he's told? And would that be good for markets?
I'm a markets guy, Peter. I'm staying out of politics. But if Vladimir Putin turned around tomorrow and said, hey, we need to deal with Saudi Arabia.
Because the last time they had that sort of loggerhead thing, markets went down. I remember, because I was on my TV show, talking about, hang on, I'm an economist here. Lower oil prices should be good for the economy, but stock markets kept falling. And as soon as those cutthroats got together and cracked the deal, up the market went. Is that a story you recall?
Yes, I do. And it's remarkable because Economics 101 tells us inputs go down, company profits go up. It should be a positive for the market. But the market's instead taken it as a signal of weak demand. Right, and that it really was just a spark today. I don't really think the oil price was that important to market thinking, but when you see a global market move 30%, it makes people think something unusual is going on. I think that's why we saw a panic today.
And do you think there are a lot of people who are saying, I don't know what's going on, but I'm getting out of here?
Look, I think we saw the fear from a few weeks back, and I think this has just escalated the fear that we are seeing. I guess looking at oil prices, it does act like an interest rate cut for consumers. But the thing to remember is that some economies are net exporters of oil and some are net importers of oil. And unfortunately for Australia, we're net exporters of oil. So look,
it doesn't show it our Bowser when we go to buy it, but still, you're right.
Well, you'd have to feel for Caltex, you'd have to think that takeover offer is probably under threat at the moment, given what we've seen in terms of the oil price. And look, the huge market reactions we've seen in terms of those oil companies today. Oil Search was down a huge 35% in one session.
But Mac, unfortunately, you're not very old. You haven't had much experience in the market. But for our investors who aren't short-term investors, who don't have to impress anyone in the short run, why wouldn't they look at these great oil companies and say, well, I'll take a 3-year view that Santos is going to be a little bit better, and what else?
Woodside,
of course.
Oil Search, Beach Petroleum, all got hit very hard today. All top 5.
So, well, you're the kind of guy who does actually buy.
I'm going to have to admit.
I don't say not now necessarily.
I bought some Oil Search today.
Okay.
At $3.50.
I knew I get a stock out of you.
That's far enough. Now I have cover for my portfolio. I do own put options, so I've got room under that cap that they give me.
You told us 3 or 4 weeks ago.
Before it happened,
it was $17,000 for 95% insurance on the $1 million portfolio.
Well, that option's now worth 12 times that, Peter. So anybody who's spent that $17,000 now has an option worth $200 and something thousand. That's a nice offset to a 20% fall in the portfolio.
Just going to show you that I don't recruit dummies for my show. Isn't that good? Imagine I didn't say that.
But I couldn't resist buying Oil Search today, Peter. It just at $3.50. Now it then traded down to $3.27 and said, "In your face, McCarthy." But that's okay.
It doesn't matter.
I'm buying it for my super for the long term, and for me that was the right level to time.
And that's a really good point. You have your short-term basket, you have your medium-term basket, and you have your long-term basket. And in the long term, say in another 4-6 years' time, are we really going to be looking back at the coronavirus? Are we still going to be talking about the coronavirus and the impacts? Or is this a potential opportunity? Yes, volatility usually takes about 2 to 3 months to work itself out. But if you're looking at that longer time frame, you'd have to be looking at it as a potential opportunity.
Look, I looked at my own Switzer Dividend Growth Fund. It copped it today. But it's a real safe kind of investment. It rebounded to 270, now it's about 223 or something like that. But like Magellan has been copping it, and we know what a great fund manager he is. But that's going to be a buying opportunity for someone who wants to wait the medium term.
Yeah, and don't forget that dividends do act as a buffer to the volatility. If your companies are still making stable cash flows and you're still getting paid out those dividends, you get them paid out regardless of whether the market goes up or down.
Yeah, exactly right. And that's why I like the safety of dividends. Yes,
well, the other thing is too, if somebody's got a diversified portfolio across assets, they'd have had a big win in their bond portfolio today, with the Australian 10-year bonds trading to their lowest yield ever. So that's the power of diversification. It's a tool that all investors can use, from the smallest to the largest, and those who've employed it carefully across the assets classes haven't done as badly as the share market.
I'm not going to let you guys leave until you give me one stock. I want another one from you. But when you eventually stop worrying about falling knives, what are the companies that have really copped it that you want to be buying?
Well, I'm mostly in cash at the moment, but I have held on to a few stocks. One's a gold stock, so just holding a gold, and ResMed as well. The fact is that the Aussie dollar is under pressure, so those companies making a lot of their earnings offshore, they're going to benefit from that.
Yeah, but I'm also going to push you, because this is what my viewers be thinking. Wait a minute, Afterpay, Xero, these are all beautiful, loved tech stocks. Today they're hated, probably not Xero as much as Afterpay. But should people think about buying these for a year's time?
WiseTech's on my list.
WiseTech?
I've started drawing up
you
my
are
shopping list.
you are courageous, because
Well, that's
it has
right.
been doing badly lately.
It's been belted, and there are
Logistic.
stock-specific issues too around its acquisitions and whether or not they've been well integrated and valued properly. So there's a lot of moving parts to WiseTech, and I'm certainly not jumping in now, but it's one on my radar. Long term, I really like it. By the way, as we recover from the impact of the coronavirus, logistics groups could do very well if there's pent-up demand. So I'm keeping that one there. Polynovo, the skin technology group, that's another one on my wish list. CSL's there, but I don't think it's going to get cheap enough for me to buy it. Did crack $300 today, though. Even the mighty CSL fell. So that's how bad market conditions are. And I've got a number of blue chips on there. Which I'll load back up on at the right time. Give me a nice balance.
Names, come on.
Well, BHP, CBA. I'll be getting back into a market-weighted portfolio at some stage, but I'll wait until the market tells me that it's the right time to move.
One more, Julia.
And during times of market turbulence, we have high beta and low beta. You've been talking about the high beta stocks like Afterpay and WiseTech, and they do fall more than the market. The low beta stuff tends to be a little bit more safety from the storm. We have seen rain. Some of those agricultural stocks should do a bit better. So Elders has still held up fairly well here. Ingham's has held up fairly well here as well. So having a look at some of those stocks like Australian Agricultural Co, they haven't fallen as much of the market, and some of them have actually made gains in the last year.
Now, I wrote a story for the Switzer Report today on 10 stocks you hold for 10 years, which I might have pestered you for in a previous story I wrote probably a year ago. But Jeff Wilson went for Breville as a 10-year hold.
Interesting.
What do you guys think about Breville?
Yeah, I think short-term consumer trends obviously are going to come under pressure, but generally you see a bounce back in terms of demand. So it's probably going to be a 2021 story rather than a 2020 story.
It was a stock to hold for 10 years. Yeah, interesting, wasn't it? The last call was TPG, which you got right too.
He's got a good name for a good reason.
Yeah, that's right. Mate, guys, thanks for joining us on the program.
Thank you.
That's Michael McCarthy, CMC Markets, and Julia Lee from Birmingham Invest. Let's keep our fingers crossed that things improve over the next week or two. Well, it's been a bad day on the stock market, down over 7%, and we're probably either in or very close to a bear market. To me, it's a big overreaction, but I don't think this overreaction is going to go away anytime soon. Let's just see what Charlie Aiken from Aiken Investment Management and Paul Ricard from the Switzer Report thinks about this extraordinary day. Charlie?
Yeah, definitely extraordinary day, one for the history books, but I mean, you can't lose sight of all that. I mean, when you run money professionally or you look after it yourself, I mean, you have to look through these situations and quite frankly, look for opportunity. Yeah. I mean, look, yeah, it's all great to have, big headlines and et cetera, but I more broadly think there's opportunity in this, and we'll get to it.
Paul?
Look, more than I expected, Peter, coming in today. Obviously, the big unknown, I think, from where we were on the weekend was the oil price and how that plays out between the Saudis and the Russians. That's the big sort of thing we didn't think about last Friday when we looked at the market. So
Okay, now let me actually pretend I'm a normal person.
Right.
And let you guys answer it. Some people would say, the coronavirus hurts a global economy, right? Through demand and supply problems. Then along come those cutthroats in Russia and Saudi Arabia, and because they're fighting, the cost of a very important cost of production goes down the mine. Something really important becomes cheaper. Why doesn't the world like the idea of cheaper oil?
Yeah, well, it will in the long term, in the medium term, but in the short term it crashes the high yield credit market.
Okay,
that's the problem.
Explain that.
Right, so shale oil gas drillers in America have been very big issuers of debt, high yield junk debt. They're a big proportion of the high yield junk markets. Obviously, a lot of those become insolvent and won't be able to pay their coupons, which is a bit right. You can see the reaction in energy stocks today in Australia. They're down between 20 to 30%, including well-known household names. But the problem of why markets are very weak today, and it'll probably be a very rough night on Wall Street, is the high yield debt markets leveraged to the oil price and the flow through to banks and financials, et cetera, et cetera. So Australia, unfortunately today, the ASX 200 is right in the crosshairs. Yeah. We are banks and resources, basically. Yeah. And the two sectors that will get touched up tonight harder than anything globally will be banks and resources. So, but it stems from concern about solvency in the high yield debt market. Yeah. Now, look, if it turns out, one day from now, this is some game between Russia and Saudi and it all calms down, I fail to believe that the oil price of $28 has much more downside. Yeah. And I think that's why the next couple of days are going to be hugely interesting in markets, because people are going to be forced to sell things that they don't really want to sell. Those with leverage, those with borrowings, those with margin loans. And inside that will be, in my view, some really interesting opportunity. Yeah. But this is about solvency in the debt markets, the corporate debt markets, and that's what the market's worried about.
Paul, there's a question you might not have the answer to, but I have to ask it. Do you reckon Donald Trump's contacted Putin and the boss of Saudi Arabia? Is he
I'd imagine if I was Donald Trump, I'd be pretty worried, and I'd imagine there probably are some discussions occurring at. Certainly, Trump would be aware of it. Whether he's talked to Putin or there's some discussion be going on between the US and the Saudis and the US and Russians, you'd expect there's something happening. I mean, as Charlie says, a lower oil price is intrinsically good for everybody, but as we know, there are not just the high yield market, there are big players in the American stock market, oil companies, big players here, and resource companies. And markets just can't cope with that sort of change in price. I expect that they'll work this out, because to date they've been remarkably successful at holding the oil price.
Yes, they have.
The OPEC and the Russians have played really good ball together.
Last time they fought, Paul, the market was down, wasn't it? And when they got a solution, the market went up.
Yeah, I'll defer to
Charlie
Charlie
remember
on
that.
but
you remember that, Charlie?
Not that clearly, but look,
maybe I did my homework better than you guys.
Look, you're just older. At the end of the day, lower oil prices are a tax cut for the world. It's actually another piece of stimulus that's hitting the world markets. So you think about it, we've got record lows in bond yields today, which is good for refinancing mortgages. We've got record low cash rates, record low. We've got stimulus coming. Even the Australian government's talking about a proper stimulus
10 billion.
So what we talked about last week, that the markets are going to swing between hope and fear, absolutely happened last week. Yeah. And the S&P actually finished up, but every day was a 3% move. Tonight, we're going to get some fear, quite a bit of fear, about contagion from the oil price, what the central bank response is going to be, and the increasing spread of coronavirus, right? So you're getting the perfect storm tonight. Solvency issues combined with, hysteria about a epidemic, and when you get that, you really actually have to get the checkbook out, because there will be a margin of safety in some businesses tonight, and that you are getting paid to take the risk. So I'm actually getting, you don't want to sound happy about what's happening, but I'm getting quite excited about the ability to deploy capital in the next few weeks. Okay. I think there'll be some wonderful opportunities.
Well, people watching this want you to name some standout ones that you've seen today and think, I'm interested. I'm not saying you're going to buy them, but what ones have instantly interested you, Charlie?
Well, I mean, I do international equities, so I don't have anything in Australia. But for the first time in 5 years, the S&P futures are now limit down. They've traded has halted, so people know that. They've halted trading in S&P futures. The last time that happened was when Donald Trump was elected, and they fell 5%, were halted. And it actually turned out to be one of the best buying opportunities in history. Yeah. And the futures actually finished up on the night. I don't think they'll finish up on the night tonight, obviously. But for me, it's about focusing in on companies that are broadly unaffected by all of this, and that have just amazing balance sheets, great businesses, and are going to see it through, but also come out the other side. Yeah. So what am I looking at tonight? I'll be looking heavily at US large cap IT tech stocks, things like Microsoft, Apple, usual suspects, Amazon. They'll get knocked around because they're equities, right? And in the clearance sale, they're equities. But what I'm thinking about is looking at that. I'm going to look in Europe a little bit tonight and see what we can, maybe I'll look at a Louis Vuitton or something like that. But I'll defer to Paul to Australia. But Australia is now pretty much down 20% in less than a month. And for those, seeking domestic exposure, there must be opportunity there. So I'm going to keep it to large cap, dominant global businesses. Yeah. But I will say to some listeners out there, viewers out there, if ever it's a chance to get some money overseas, it's right now. The average self-managed super fund only has 2% of its money in global equities. There is a chance to deploy into global equities, into this route or whatever you want to call it. So, you've probably all got enough banks, you've all got enough resources, but there might be a chance to diversify through all this. And I think that today reminds you of the leverage of Australia to commodities. Yeah. So we've got the Aussie dollar down a couple of percent, we've got the Australian share market down 7%. And just remind you what we are, albeit I think
And
there's
before
opportunities.
I'm going to ask you the stocks you like in a second, but one last thing with Charlie. You mentioned the currency.
Yep.
It was down to 63.
Yeah,
Where
it
is
was
it
some
now?
sort of flash crash
Where
there
is it
today.
now?
It's down about 2%, around 65-ish.
Yeah.
But I mean,
But
fair enough.
yeah.
That is a safety valve for
Yeah.
us, so that's okay.
Yeah, but I often use the Aussie dollar as the canary in the coal mine. But that is an example of excessive sell-offs, even on the
I
Aussie
think it
dollar.
was, to be honest, I think it was a flash crash. I think it was something technically.
Fat finger problem.
No, it's something technically happened. It's a low liquidity. In Asia, the Aussie dollar is not that liquid. So I think that was some sort of flash crash.
Okay.
But look, these things happen in these dislocating markets where computers are the main market maker. You can have these spreads blow out. Anything can happen. And that's why people, you can actually have, there may be the chance in the next few days to buy wonderful businesses at wonderful prices.
Yeah.
They're really good.
Yeah, Paul?
Well, I'll say two comments. First of all, I think some of the defences have held up really well, so that's not what I would not now be
They
looking
haven't
for the
fallen hard
defensives, right?
enough.
They haven't fallen enough, right?
But that's what defensive stocks should do.
That's what defensive stocks have done. So if you get a rebound, they're not going to go much. So I would now actually put CSL in that same category. Love the stock. Only just at the end do we see a bit of pressure coming in. That's held up so well. So I'd now look at, I think this is the time for the brave, right? So this is the time almost to start to look at resources, right? I'm not saying the oil price is bottomed. Or BHP is bottom, but this is the time when there's going to be some great bargains around in some of those stocks, right? So,
So
the ones that have
BHP and Rio you like? Or Fortescue?
I prefer BHP to Rio or Fortescue, right?
Is BHP down to 12% or something?
It's down 12%, 14% on the day
'Cause
or
it is
something,
an-
right?
it is an
Yeah,
oil
it's
supply.
below its buyback price of a couple of years ago. Look, it's a well-run business. It's got lots of cash. It's not under any pressure. Not as though these companies are leveraged, right? They're not. They've got almost no borrowings, right?
Charlie said the
So-
banks have copped it.
I think some of the banks look all right. I think it's all overblown on the banks, but we get caught up in sort of, the high yield debt market stuff is going to impact banks. It'll have much greater impact on US banks than it will Australian banks. Their main exposure is to mortgages here, right? Domestic mortgages. Property market hit another record peak on the weekend. It's the dislocation is yet to come in property. Look, they'll find it a bit hard to borrow money because that's what happened in a flight to security. So spreads, we get a contraction in spreads. Only the best borrowers are able to borrow, so it becomes a bit tougher. They'll have to pay up a little bit more on some of their borrowings. But they're not, so they're getting caught in sort of this idea that there's going to be a lot of, businesses going to feel the pressure, and they will. But I think we've seen a huge fall in banks. So I'm looking, I know what Charlie said. I think my caution is don't go for the defensives there too late, right? They haven't moved enough.
There's
right?
no point buying defence now, right? If you want defence, you may as well take your money out of the
that's
market.
right. Yep.
To get out of equities, you want total defence, but don't bid up defensive equities, in my view. But
This is the time to be courageous, but go for good businesses that have been really badly
in
beaten
an
up.
Australian New Zealand context, there is one defensive sector that has been hit very hard, and that's actually the airports, for obvious reasons.
Yeah.
I do think things like Sydney Airport and Auckland Airport in New Zealand are interesting, considering where cash rates are. The other thing worth noting on this day of terrible news or bad market action is, firstly, Shanghai Disneyland started to reopen. Secondly, the South Korean infection rate has slowed. And you're starting to see that quarantine works. So I can't tell you what the oil price is going to be or how the Saudis are going to behave, but quarantine works for this infection. There's no doubt. China is starting to reopen and the Koreans seem to be getting a grip on it. And finally, the Italians have actually quarantined the whole of Lombardy. So if it gets the worst comes to worst in America, we know what's coming. They're going to shut down the New York subway system. They're going to shut down Disneyland. They're going to shut it down, right? And then you really know. But quarantine does seem to work on this virus. So in amongst all this mess today, there was actually some mild bits of good news in the countries that have experienced the biggest hit from coronavirus the earliest. And to me, that's really interesting too. The other thing worth not losing sight of, and it is a day to be very clear on what you think, is we will come out of the other side of this. And whenever that is, it might be 3 months, 6 months, 9 months, I don't know. But we will come out the other side of it. We will have the lowest interest rates in history, the lowest bond yields on history, massive fiscal stimulus, and potentially an energy price that's very low too. It is also worth remembering, on Friday, the US confirmed that they had added 273,000 jobs in February, better than expected, but also the previous months had been revised up. Pre this virus, the US economy was in rare, excellent shape, just really good shape. So don't lose sight of how we came into this. This is not the GFC. Banks now have 13% Tier 1 capital, not 4%. They can see this through. Can their share prices be volatile? Of course they can, but they can see this through. This is not a financial crisis. Yes, there's going to be pockets of distress in the high yield bond markets. I get that. You bought junk, you get junk. Remember, viewers, high yield generally means high risk. So be careful with that. And the other thing I will be certain of is if we are sitting here in 1 year or 2 years from now, I will guarantee you that the best equities or the right equities will smash the return on cash. There is also a scenario here where you come out the other side with so much liquidity swashing around that equities do really, really, really well. And I think that is not a ridiculous scenario. So,
yeah, particularly where term deposits are.
yeah,
stocks,
but it's also, well, this all happens so quickly now, Paul. Like, Australia just fell 20%.
Yeah, I mean, I don't think any of us on Friday night, when we saw what happened to Wall Street on Friday night, expected the market to be down 7.5% or 7.4% today, right? Yeah. We didn't know about the oil issues, a few other things, but even the reaction I find is just...
It's over the top.
It's over the top today, which I suppose, you've got to remember Australia, Melbourne was on holiday, it started a thin day, it's a Monday, which is always the hardest day because it's Sunday in
Who would have
Sunday
thought
night.
we missed the Victorians?
So, who would have thought we would miss the Victorians? But
we
but
did.
we opened bad and we went bad all
They'll be
day
buying
and it didn't
tomorrow
get any
morning.
better and Asia's joined in. So we could actually say we've actually sort of partly helped led the world down. But
It's interesting though, the region was reasonably discerning in what it did.
China was discerning.
The
China did better
banks
than...
hammered,
Yep.
resources hammered, obvious, still consumer stocks a bit, those at the very pointy end under pressure. But it actually made sense relative to the news, what was happening. But to me, the opportunity sets, overseas tonight. It could be a very messy night tonight, Pete. There's no doubt about that.
Personally, I'll be waiting a few more days to see this work out. I hope to see a bottom formed and we start climbing out. But I think I'll be buying Switzer Dividend Growth Fund, mate. That's been clobbered today, and it's a nice little dividend
My
return.
only bit of advice to everyone, and it doesn't matter, you do whatever you want that suits you, whatever you feel comfortable with, but you've got to come out the other side of this in equities with the absolute best portfolio you could have. Resist the temptation to buy junk. Very good companies are on sale. Very good companies will be around 1 year, 2 year, 5 years, 10 years from now. Don't be tempted to buy rubbish. This is the chance to buy the best equities in the world and locally, and that window does not stay open for that long.
Charlie Aiken Investment Management, and Paul Ricard from the Switzer Report. So I'm talking to St Wong from Prime Value. He's a portfolio manager. And I've got to ask you the question, St, how worried are you about this morning's sell-off of the stock market?
Well, Pete, is obviously quite disconcerting given the price actions we've seen. A lot of it, I think, at the moment is fear, and that's causing a lot of sell-down in the market. I'm personally quite interested in what's going to happen next week or two. That would help me determine if this is going to be a bigger issue than what we're seeing in the short-term sell-down perspective, Pete.
Yeah, so last week, the big fear was around coronavirus, and my argument was I wasn't prepared to buy until I started seeing some improvement in the infection and death rates. But this is a new curveball. It seems to me it's the oil price headlines, the oil price war headlines that have hurt the market today. Is that a fair call?
That's, I think, on the ball, Pete. That certainly contributed to the sentiment on the negative side of things. I think what's also compounding this effect is obviously commodity prices are generally quite weak. Coming into the weekend, I was generally quite comfortable. The oil price is obviously a concern that I'm bearing at the moment. I'm trying to work out what exactly is happening on all front. But Pete, to put it all into a framework, and that's how I think about the situation at the moment, is to boil down to three simple, questions I'm asking myself. First of all, the trajectory of global economic growth. How's that going to go? Whether it's stabilizing, accelerating, or kind of decelerating. The second question, Pete, is obviously the perspective of governments, central banks, the role of governments in stimulating the economies around the world. How is that going to play out? And finally, from my perspective, is how patient am I going to be in all this? Because from my perspective, is that I think if I'm patient enough, I think we will see the market recover, economic actually recover, and that's my perspective of things at this juncture.
Okay, so I presume even though you might not be doing it today, well, maybe you are, you'd be trawling through what stocks have been clobbered, trying to look for companies that you want to hold for the medium term to long.
Yeah, absolutely, Pete. I kind of break into three buckets, right? The obvious stocks which have been, I guess, clobbered, as you suggest. Obviously, frontline stocks, anything to do with logistics, travel, that's obviously been clobbered, and that's bucket number one. And eventually, things will recover, and certainly that's a bucket to watch for. The second bucket is obviously the second derivatives, I guess, bucket or category. Companies involved in financial services, their concerns that liquidity is becoming scarce, and that's affecting banks, financial institutions, companies which are dependent on the market, such as fund managers, for example, and companies which are dependent on the market to raise money to fuel their growth. That's the second bucket. The third bucket is probably where I think the most comfort level in finding companies which are just tracking along, but hardly affected by what's happening globally. Companies such as Amcor, in my view, Steadfast in the insurance broking industry, and even Australian Finance Group, the mortgage brokers, for example, these have just come off like 20-30% quite easily. So these are the kind of companies I'm kind of gravitating to at this moment.
Yeah, okay, so when do you think that you'll feel comfortable to start, picking up some of the companies that you think have been oversold?
I think it really boils down to two key factors, right? One is obviously, if I'm patient enough, some of these companies will recover, and companies such as Amcor at $13, I think we'll be quite comfortable picking such companies up easily. The second broader question is, of course, when is the market going to change direction? Right? When is the sell-off going to end? And it's going to be a broader perspective, and I guess the key signals I'm watching for, really boiling down to, I guess, 2 or 3 key points is, first of all, containment of the virus situation. I think that'll put everyone at ease. And certainly companies, rather governments kicking in, we're seeing RBA cutting interest rates, government coming through with stimulus, the Aussie government coming through with stimulus possibly as soon as this week. So that will help the market stabilize and begin the recovery prospect, in my opinion. So that's when I start to be much more comfortable. If I had $100 to play with, I probably won't use my bullet at one go. I might stage it on a 30% in one scenario and another 30% going forward. So that's how I'll be playing the market at this point.
Yeah. Would you be waiting for a bottom to be formed in this excessive sell-off before you actually started to buy?
As we saw in the last 12 months, we're never going to pick the top and we're never going to pick the bottom. So I think that's a fair approach to take. And if that's the case, then kind of splitting my bullet into 3 is probably a sensible way of picking up stocks and getting exposure to the market as the sell-off normalizes or kind of troughs.
Yeah, you mentioned Amcor and Steadfast. What about a company like Qantas that was really flying high, has really been clobbered, but still remains a wonderful airline? Is that going to be a possible buy for you?
Absolutely. As I mentioned earlier, Pete, it really falls into the first bucket of companies which have just clobbered because they are on the front line of, I guess, the virus situation. And it really remains that Qantas remains a fairly solid company. And I think it will rebound quite strongly once things start to normalize from my perspective. So yes, in an absolute perspective, Qantas will look fairly interesting.
Okay, at what price would you start doing handstands for CBA and go in and buy some?
Well, Peter, I was just looking at CBA this morning. It was trading at $73. From my perspective, it's still quite on the high end of things where valuations are concerned. Now, I know the yield's looking very attractive. I think it's probably yielding about 6% at this point, which is great. With rates coming off and probably going lower, I think going back to where we were again, if I were to overlay where the GFC is concerned, if I see some of these companies drop off, the banks specifically drop off 20, 30, 35%, I think that's where my, I guess, threshold of interest start to pick up. And I might lose another, I don't know, maybe 10% from there on, but that's fine if I'm patient enough, because I think when this kind of normalizes in 12, 24 months' time, I think I should be ahead where a company like CB is concerned.
Excellent, mate. Thanks for joining us on the program.
Thanks, Pete.
That's St Wong from Prime Value. And before I go, I just love to invite you to our Investor Strategy Day. And we're going to have the former Treasurer and Ambassador to Washington, Joe Hockey, coming in from Washington, joining us via Skype. And we're going to talk to him about the upcoming US election, the fact he plays golf with Donald Trump, and also the coronavirus, and of course, the oil price collapse, which we've seen recently. Mr. Hockey will be joining us, and you'll get a chance to ask some questions as well. We're going to be in Sydney on Tuesday the 17th of March, Melbourne Tuesday 24th of March, and Brisbane on Wednesday the 25th. Tickets are strictly limited and will sell out, so secure yours at the link in the description of this week's episode, and we look forward to seeing you there.